We got the release of the inflation numbers for June, and there was a lot of anticipation that the CPI data would come in good, which is lower than expected. And we have had a lot of better than expected CPI numbers that have come out recently. In fact, we've had a record number, especially now after today. We have the longest streak ever of consecutive declines in inflation, at least as measured by the CPI. I think it's 27, I'm not sure how many months. It's a 27-month low where we are now in year-over-year CPI. I'm not sure how long this streak has run, but I read that this is now the longest streak of declining CPI.
In this video, Schiff discusses the recently released inflation numbers for June and uncovers a surprising twist that challenges prevailing beliefs. Schiff begins by highlighting the anticipation surrounding the Consumer Price Index, CPI, data, and the expectation of a positive outcome. However, what unfolds is beyond what anyone expected. We learn that the CPI has been experiencing an unprecedented streak of consecutive declines in inflation, setting a new record. But are these numbers as reassuring as they seem? While the actual CPI increase of 0.2% aligns with predictions, Schiff reveals that when annualized, even such a seemingly small increase equates to around 4% inflation. Far from the desired 2% target, this reveals a significant concern. Additionally, he emphasizes that the Fed's focus lies on core inflation, which currently stands at 4.8%, a long way from the intended goal. But here's where it gets fascinating. Schiff reveals an intriguing connection between the better-than-expected inflation numbers and a potential catalyst for future inflation. Could the very data that appears positive be fueling the fire for hotter CPI figures? This realization has profound implications for the market. Stay tuned until the end of the video, where Schiff unveils his predictions on the price of gold and oil. Discover what crucial piece of the puzzle the market might be missing, how it could impact your investment decisions on gold. Don't miss out on this thought-provoking analysis that challenges conventional wisdom and promises a unique perspective on the future of inflation.
But the anticipation was that we would have a more benign number than the 0.3% that was forecast. And of course, 0.3% is not really benign. I mean, you annualize that, what is that, about 4% inflation. So it's still a pretty high number if your goal is 2%. And again, remember, when official inflation is 4%, the real rate is more like 8%. So we've got a lot of inflation here. But the actual number that we got was increase of 0.2. That was in line. I mean, the range was from up 0.1 to up 0.4, but 0.2 was still better than the 0.3, although it was higher than the 0.1 that we got in the prior month. So, it's going in the other direction, but it was still lower than expected. The year-over-year number also improved more than expected. It was supposed to fall to 3.1, and it fell to 3. And that's versus the prior month where the year-over-year was 4. The ex-food and energy, the so-called core, that was supposed to rise by 0.3, and it rose by 0.2. And that was an improvement over the 0.4 for the prior month. And the year-over-year core was supposed to rise by 5%, and instead it rose by 4.8%, which is an improvement too over the 5.3% for the prior month. But remember, it's the so-called core that the Fed is most concerned about. And that's what it wants to bring down to 2. Well, we're barely below 5. We're at 4.8. We are nowhere near the Fed's goal. Yes, we've had an improvement over the 9% plus, which was the high watermark so far for the CPI. So we have had an improvement relative to where we were then. But we haven't gone anywhere near 2%, nor do I think we're going to get to 2%. That's what the market doesn't seem to understand. And it's ironic because these better than expected inflation numbers, as I've been pointing out, are in fact a catalyst for more inflation, at least for hotter CPI numbers. So you get these better than expected CPI numbers or declining CPI numbers. They get the markets to think, okay, the Fed is done. It can ease up on the inflation fight. We don't need as many rate hikes. The Fed could cut rates sooner rather than later. And the minute the markets perceive a window of opportunity for the Fed to be easier in its monetary policy, you get sharp movements in the market, particularly the US dollar. The dollar is getting clobbered today. This is one of the weakest days I've seen in the dollar, certainly this year. The dollar index is down about 1.2. So it's down 1.2%. It is now at the lowest it's been since April of 2022. So what, about a 15, 16-month low in the dollar index. As I'm speaking right now, the dollar index is at 100.56. Dollar was very weak following the weaker than expected jobs report that we got on Friday, and now it's down again today. And oil, as I said, continues to rise. It's been creeping higher all week. It's not up dramatically today. It's up about half a buck, but we're now at 75.22. We were at $68 last week. So we're seeing a nice move up. I think there's a lot of momentum. It's not just in oil. Commodities across the board are having a very strong day. Obviously, the precious metals having a strong day as well, especially silver. Let me pull up a live price there. Last I checked, it was up, I think, better than 50 cents an ounce. Where is it now? Oh, it's not even. I'm not even seeing it on that page. Let me check it. Silver's up 96 cents, almost $1 an ounce today, above $24. That's why some of these silver stocks that I own are up 10 or 11% just today. But the point I'm really trying to make here is that the better than expected inflation numbers are actually a catalyst for future inflation to be higher. Anyone who is looking at the recent improvements in the CPI is basically looking in the rearview mirror. They're ignoring what's happening through the windshield, which is the dollar tanking. And in fact, I think if the dollar breaks much more, I think the dollar index is going to make a sharp move from 100 to 90. There's some support down at 90 on the dollar index. And so I would expect that if the dollar does break about 10%, it will stop falling, at least for a while, at 90. I mean, if it doesn't bounce off at 90, then it's in even more trouble than I suspect. I mean, it's in a lot of trouble, but it should bounce off of that level just looking at a chart. But that's a big drop. That's a 10% decline. If we get a 10% decline in the dollar in a very short period of time, maybe the next month or two, that should really ignite a fire in the commodity markets, particularly in oil. I would expect the oil price to shoot above $100 a barrel if we get a 10% drop in the dollar. I also would expect gold to make a new record high. It'll probably move above $2,100 an ounce if that, in fact, does happen.
As we reach the end of this captivating exploration into current economic events, I hope you've gained valuable insights into the ever-evolving financial landscape. Remember, staying informed about the latest economic developments is crucial in today's interconnected world. By understanding the forces shaping our economy, you can navigate the uncertainties and seize opportunities that arise. Whether it's market fluctuations, policy changes, or global trends, staying engaged with economic news allows you to make informed decisions that impact your financial well-being. Stay curious, stay informed, and don't forget to like, comment, and share this video.